Hello, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 12th of February, and we have Brent crude oil this morning trading a little bit softer, down about 0.33%, but still holding firmly above $75 a barrel, trading today at 76.74. So somewhat of an upward push over the recent trading sessions, and perhaps taking a bit of a pause today. Hard to identify exactly what's pushing it in either direction. It seems this morning that there is some sense of support, or there was yesterday rather than in terms of easing off today. But this morning, the big inventory climb in the US reported yesterday. Let's kick off this morning with Maliha Bengali, founder of MB Commodity Corner, and start with the Fed. And whether the Fed, how relevant it is, but ultimately, Maliha, your thoughts on the comments yesterday by Jay Powell, essentially saying that the Fed is in no hurry to cut rates any further, and that expectations on easing will have to be delayed. Your thoughts on the relevance of those comments and that position of the Fed?
Thank you, Sean. You're absolutely right. So the market right now, from pricing in many, many cuts, is pricing about maybe one more cut for this year. The Fed really, what they're trying to say is the data actually has held up quite well. The labor market is showing signs of softening, but it's still very robust. There is really no need to cut rates because the economy is on a solid footing. However, they have the tools, as they keep talking about, to do and take the measures if it needs to be done. We know that the bar for them to raise rates is a lot higher than the bar for them to cut. So there's a bit of a dovish Fed pause, if you may, is how they look at it. But the data right now, the market's focus is more on inflation. We've seen a massive rally in US 10-year bond yields through the end of last year. There's talk of Trump tariffs. Inflation is pretty much on top of everyone's mind right now. So the yields have sort of backed off in the last few weeks. And the question really is, with all the treasury supply, is the CPI going to be staying around 2.9%, or will it take higher? If it does take higher, then that puts the Fed in a very tough predicament. And I think the market is very focused on inflation because that's the answer to all the problems in terms of dollar weakness or strength, the bond market. And we can see the equity market is actually flatlining here because the yields are the ones that are sort of threatening to move higher. So we're watching today's data and PPI to see what the effects would be.
Neil Atkinson, the former head of oil markets division at the International Energy Agency, currently today sitting in Paris, as he does every day, the lucky fella. Neil, your thoughts on what, the good old-fashioned, your former sort of bailiwick, oil inventories in the US surprisingly growing quite a significant amount, 9 million barrels as reported yesterday, which has given a somewhat downward pressure on oil prices after a few days of upward movement. Your thoughts of where the fundamentals of this oil market are currently, behind all the Trumpian headlines? What's the fundamentals behind the curtain there?
Well, old-fashioned is one of my favorite phrases. I love it. And as far as I can see, yes, I personally do not get too excited about weekly data in US stocks, frankly, because they're often corrected subsequently, and the picture can sometimes be very different when they are corrected. But yes, so there was.
And typically the API less reliable than the EIA.
Well, it's not a question of reliable. It's just based on a smaller sample. And it's a good indicator. We always used to use it when I looked at these things on a daily basis. The EIA numbers are based on a more comprehensive survey, and they're therefore a better sample. Now, the underlying fundamentals have really not changed very much, despite all the Trumpian noise and that I saw week before last in Washington. The demand is going to continue to grow this year at a fairly solid clip, just above 1 million barrels a day or so. We know where we stand on non-OPEC plus production. Drill, baby, drill has no relevance whatsoever to what's going on in 2025. And indeed, I suggest little relevance whatsoever to the whole of the Trump term. So we know where we stand on non-OPEC plus production. Will OPEC put some barrels back into the market in April, as is possible? Personally, I doubt it, unless sanctions against Russia and Iran really do look as if they are going to bite significantly, in which case the OPEC plus guys, obviously leaving aside Russia here, but the OPEC guys, let's say, will have an opportunity to put more oil into the market to take advantage of a weakness as far as Russia and Iran is concerned. So I don't think a great deal has changed. And 1 week's numbers from API and later today, of course, from the EIA, don't really change that very much.
Let's welcome Janiv Shah, Vice President, Oil Markets, Refinery and Crude Balances Lead at Rystad Energy. Janiv, looking at the big players in Asia and particularly where it follows through from a relevance for refinery runs, if we can just start on that and on the downstream side, obviously China, generally bearish outlook there. India now, we've got Narendra Modi going to the US, to Washington today to meet with President Trump. India looking very disappointing in terms, not that very, but ultimately compared to where it thought it was going to be 8% growth. Now the World Bank saying just above 5%, which is, you know, for a big country like that, not where it needs to be. But where are we at? But both those countries, massive refining capacity. Where is that going? We know the kind of general crude story, but where's the refinery story going?
Well, Sean, thank you for the question. Just want to touch back on what Neil mentioned, and agree with the numbers that Neil's mentioned here with global demand growth over over 1 million. But the real question is, what would OPEC Plus do with the next sort of quarter? In terms of refinery,
and I know that Rystad have been quite focused on the idea that OPEC are kind of fudging around on quotas by getting deeper into the sort of product side.
Correct. Yes, there's a Middle East axis where OPEC Plus still do control much of the crude markets in terms of production and output and exports, but now have in the last few years, because of the refinery configurations and the expansions, have also played into the product exports, so giving barrels back into the market. Exactly so. In terms of the Asian refinery space, a huge number of additions and expansions, especially with China and India, to name the top two here. Yulong Train 2 is set to come online within the next few weeks or months, as well as expansions at Daxi and Zhenhai refineries, respectively, right? So you've got a large number of additions, but let's not take away from the fact that there are citywide refinery environmental-based reasons why refineries are being relocated, as well as teapots closing down due to various reasons, right? So the independent sector is something that's being very hard hit by the latest sanctions and the lack of crude availability, so the crude crisis, because of the lack of discounted barrels from Russia and potentially from Iran to come. But we do see some small growth within Chinese runs because of the increase in naphtha and jet demand coming into this year. Although diesel and gasoline continue their peaking and or slight decline from here on out. With India, something similar, some growth this year, of course, but the large expansion refineries and new refineries have been delayed somewhat. So there is a little bit of weakness in the tension in the market, which we will see. Should demand hit coming into the rest of this year, that's where we would see some acceleration, so to speak.
Malia, I wanted to pick up on your earlier comments and sort of a theme of mine this year so far, at least until I've kind of find the cookie, and that is, what is the new North Star for the global oil markets? The China incremental demand growth has been ultimately the principal North Star for the last 30 years or so. It is now dead. What is the new North Star, or something that this market could hang its hat on this year? Last year, it seemed to be, was the last year in which we woke up in January saying, oh yeah, China is going to save us again. It didn't. What are we looking for this year? What does it look like? Do you have any sense of what a new North Star could be?
Well, the big thing for China this year is, when do they come up with the stimulus? We know the economy needs massive stimulus. We spoke about numbers from 5 to 10 or 20 trillion. The question really is, China is stuck in this sort of situation where the consumer is weak. Inflation is actually not a problem. It's actually deflation. Bond yields are going lower and lower right now. And it all actually rests on the dollar. So it all goes back to the Fed. China cannot do any more stimulus because the currency is very weak. If they do it right now, the yuan's going to collapse. If the dollar starts weakening in due course, that will give them some room to sort of maneuver and sort of, help the economy. So the whole thing rests on Chinese demand, and Chinese demand will only come once their currency is a bit more supported. They can actually.
So that's over. That's the point I'm making. What is the new what is the new? Is there is quantitative easing? Is the easing cycle? I mean, what is the sort of the prop other than obviously OPEC Plus continuing to shut in supply, continuing to maintain the line there? That's on the supply side. Where is the sort of demand North Star? Should producers be looking to Africa, for example?
You're absolutely right. I think there's a secular change in China. We're not going to be having the same model that we did in the last 10 years. They're actually, going less towards diesel. They're more towards LNG. There's a secular demand shift. And I think OPEC and the rest of the world needs to wake up to those demand numbers, because they're not demanding. They're much more price sensitive, as Clyde keeps talking about in his podcast. And I think they are very sort of keen takers in buying when price gets below $70 and selling and pulling back. So China's model has shifted. But other than that, the big thing is on back of the yuan and the dollar. If the US economy starts rolling over, showing signs of weakness, and the dollar rolls over, that's going to actually give them room to start stimulating. The Chinese markets have picked up right now. So the big thing is liquidity. We're keeping a very close eye on exactly when they start pumping the money in, because that's going to lead to a renewed demand. But the demand will be nothing close to what it was in the last 5 or 10 years, because the demand cycle has changed. So you're right. We need to look to other areas, whether that's US growth, OECD growth, or Africa. But China is not going to be the bellwether it was in terms of the demand numbers as we're used to.
Neil, we're now a few weeks into the second Trump administration. There's been clearly a kind of an avalanche, a tsunami of headlines and positions and policy quasi-headline positions and executive orders and so forth. What actually is anchoring on the ground, it still seems difficult to read. But are you getting any kind of firm grip on whether Trump will be bullish or bearish for oil prices this year when you sum up all the noise and combine it into the sort of the mixer with the policy changes? Is Trump bearish or bullish this year, do you think?
Well, cop-out answer, it depends. I mean, I spent a week in Washington a couple of weeks ago, and I got to meet quite a few people, including our friends at the API. And the sense is that, quite frankly, drill baby drill makes no difference. It's just rhetoric, and Exxon, Chevron, and Conoco who big players in the shale patch, are immune from that kind of directive. But where Trump,
will they be able to sort of turn? I mean, all of these the regulations that are being sort of suspended, if you like, methane won't be policed, methane leakage and so forth. These are all pretty attractive developments that you would think would get them back into the field spending money.
No, they won't. I mean, those things are, in my personal opinion, regrettable. But I don't think it's going to make any great difference to the short and medium-term strategies of ExxonMobil, Conoco, and Chevron. What could be bullish as a result of Trumpian rhetoric that does actually turn into action brings us back to our French sanctions. And, I did a couple of presentations a couple of weeks ago where I tried to look at the market in 2025. And if you look at the oil market based on nothing changing from where we see things currently, i.e. limited sanctions, continued growth in demand, non-OPEC plus supply, blah, 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 you find a market which is actually oversupplied on paper. But if you start plugging in some estimates for sanctions against Russia and Iran and possibly even Venezuela, although let's leave Venezuela out for a moment, you could, depending on the severity of the sanctions, see a market balance which is, if not transformed, certainly sent closer to balance than the implied surplus that we're currently looking at. So Trump could be bullish for the market in terms of taking actions which lead to a reduction in supply from Russia and Iran, which are both very important. So yes, he could be bullish. But Trump's mind is very hard to read. And for someone like Trump, there's a sort of suspicion on the part of some analysts that he would quite like a triumph in terms of bringing Iran back into the fold somehow or other, given that Iran is very weak currently. It's lost Syria, It's lost its proxies. Hezbollah and Hamas are very weak, and Iran is in a weak position. So this could be an
What
opportunity.
about the announcement yesterday, Neil? Just a quick follow-up on the suspending of the sort of the limits on U.S. companies for bribing foreign officials in resource-rich countries. That has always been a major kind of restraint on American companies, particularly going into Africa. Does that look to you like any kind of game changer?
I doubt that it's a game changer as such. I mean, again, it's I think a regrettable measure. I mean, in all my years with Petroleus de Venezuela, nobody ever offered me a bribe, sadly. But those days I think are long gone, and I don't think it is a major game changer. It's not just U.S. jurisdiction in issues like that. Of course, global companies operate in different countries, different markets, and they will still be liable. Legally liable under, say, EU law or the law of other countries and jurisdictions. So I don't think I don't think US companies are going out there with sackfuls of cash looking for their nearest Nigerian that they can.
I suppose
it's
where it might make a difference is I think particularly in Africa, but where the US have been retreating from, not necessarily by the parameter of, the old classic brown paper bag bribe definition, but ultimately just even having intermediaries, having fixers, having people on the ground who make introductions, even all of those sort of definitions became quite restrictive under that law, and American companies just said it wasn't worth the headache. So it'll be interesting to keep an eye on that, particularly in Africa. I wanted to come back to you, Genevieve, on your statement, or not your, but Rystad Energy statement at the end of your sort of vision for the year ahead, presented at the end of last year, which was that we're on the brink of a major shift in the oil market, as was articulated by your colleague Mukesh Sahdev, who leads that division of Rystad, and the idea that the protectionist 2.0 comes up against the expansionist China moving beyond export-led growth. As we now go deep into the second month of this year, is that sort of forecast prediction coming true?
Well, multiple variables there that have, of course, evolved over the period of time. What I would mention here is, the Trump 2.0 with drill, baby, drill, and other elements was very, very much limited in terms of production growth, right? But in terms of policies, sanctions, and volatility that the Trump policies have provided onto the just Brent and then other markets, has been a little bit unforeseen by the market in actuality. So that's one factor there. The next one to talk about is China 3.0. China 3.0 was along the lines of the expansionist, the demand center coming from outside of China that China is technically fueling, through ports acquisitions under roads or pipelines, etc. So the growth from China is indirectly coming from outside of, which we are continuing to see, very early days coming into this year now, but we will see coming through the next few months. And then the third element of that was OPEC 4.0 or OPEC Plus 4.0, which essentially was along the lines of how OPEC Plus will continue to manage the market, but not just, the quotas on production on crude, but how this could play into the products market. Now, very much still yet to come in terms of this year and the evolution of our forecast from the end of last year. But what I would mention here is the expansion of refinery runs and putting products out into the market, especially right now in this time period where we're going through the peak maintenance period in the Atlantic Basin, is very much going to put a lot of pressure on margins coming through to the end of this year, right? So with the demand growth that we're seeing of just over 1 million barrels year on year, and of course a lot of that is not in the diesel gasoline, and once more is not in China, the typical driver of pure demand. This is going to put a lot of pressure. Now, I say that because if you look at, as Neil mentioned, the raw fundamentals here of the crude balance globally is in a slight deficit, but the total liquids balance is in a surplus, right? It's in a growth period, especially through the second half of this year. So that's where
the supply side, you're saying?
Total
liquids.
total liquids, right? So we're
Right.
saying, product stocks growing, and that's going to put a lot of pressure on margin, well, cracks first and then margins, and put some back pressure on what production could be. So yes, there might be a reversal of the OPEC plus cuts. So, the incremental growth coming into Q2. But this is very much a tight market where there are multiple levers that OPEC Plus will have to look at and discuss in order to manage the market at, the rates that they would like, especially looking at the backwardation.
Let's go to the survey question, which is focused on the subject we were talking about this morning. The Fed says it's in no hurry to lower rates further. Is this bullish or bearish for oil prices in 2025? There has been expectation adjustment, but ultimately lower rates, or rates not changing or sort of finding their new neutral point at this level would indicate that the economy is very strong, and so demand should be fairly solid. And of course, inflation will be a factor. Or, is it just, well, we have no idea, like the rest of us, what the Trumpian policy change means. So Jay Powell is sitting on the sidelines. But ultimately, is this bullish or bearish for oil prices in 25? That money, the cost of money, will not be rising by the Fed. So that's depends what week you ask me the question. I might give a different answer, but I'm asking it today, and we will look at that. Malia, I wanted to get your thoughts on where we're going from the point of view of the paper, the funds' appetite for investing in the oil markets. We saw last year that we went through periods in which it was quite elevated, where the funds poured into the oil markets to pick up a lot of paper, and then periods when it was the exact opposite. Your thoughts on what the outlook now is, the outlook for this year, what role the funds and the money markets can play here?
I think the funds are keeping a very close eye on manufacturing. I think the point we miss about the North Star is that manufacturing has been weak for the last 3 years. The ISM has showing signs of picking up again. We're above 50. If manufacturing manages to do a bit of a pickup here, recovery, I think that's another factor that could lead to oil demand or demand for other commodities. It's still very early doors right now. So the market is wondering, are we in an expansion phase or a contraction phase? Because we know services has been strong, but not manufacturing. So I think the funds are keeping a very close eye on that, because once you see hints of that picking up, demand might go into copper, oil, and some of the base metal economically cyclical commodities. It's very early right now, and also the answer comes back to China, but manufacturing is key here, and I think that's going to determine as to what the funds do. But the oil has been a very boring commodity for the last 3 years because there is no shortage of supply. We keep talking about there is no shortage. When you look at gold or silver or other commodities, there's a lot more appetite for the real shortage, and commodities are all about demand-supply balance. So the funds, unless they get a wind of some sort of deficit, or I think there's no reason to chase anything other than value, right? So, but I think manufacturing is key here for right now.
Neil Atkinson, I wanted to get your thoughts on sitting, as I said at your intro, in Europe, in the center of Europe, there in Paris. Europe has got some big moments coming up. It's currently exposed to highest natural gas prices in 2 years. The German elections coming up in 10 days, to actually the exact same day, I think, as the anniversary of Russia's invasion of Ukraine. Can you put all of those things together and see what kind of stress or what kind of forward-looking picture for Europe this year?
Well, Europe is in a very difficult situation. In so many of the leading countries, you have political paralysis. Germany has an election coming up. France has a...
Which should help relieve that paralysis, right? In the sense that if Germany delivers something definitive or some stronger new leader, that might be helpful to Europe.
Well, it might, but we'll have to wait for the outcome. But Germany has huge problems in its industrial sector because of very high energy costs. The Russia-Ukraine situation might play out in such a way that, again, speculating wildly here, there could be the return later in the year, perhaps, of Russian gas to Germany. Who knows what will happen. But France, is run by a too clever by half president who shot himself in the foot last year with legislative elections. There is paralysis. The UK government doesn't seem to know whether it likes Europe or the United States more one than the other. Europe is in a tough situation, and high energy costs lie at the root of a lot of those problems. It isn't just high energy costs, of course, but Europe is in a very, very tough situation. And the stark contrast between the sort of bombast and optimism, if you like, of Trump and the US economy, the strength of the US economy that lies behind it, and moves, whether you like them or not, to loosen regulation on various industrial and economic sectors in the US, stands in stark contrast to the sort of leaden hand of the European Union and others that talk about big strategies and multi-year plans, competitiveness strategies for Mario Draghi and so on and so forth. Europe is in a mess, and it's very difficult to see this year how things will improve.
And yet we're seeing the FTSE 100, the stock market of in London hitting records, the German DAX hitting records. I mean, there's sort of these kind of two worlds that seem to coexist in Europe at the moment. The companies that are listed on these stock markets are getting record high valuations, you presume because they're making profits, and yet the macro economy, how does that coexist?
Well, that's an extremely good question. Where are people looking to put money? It does seem bizarre given the underlying fundamentals, particularly here in Europe, whether they be economic or political, are extremely weak. And I do not understand how people can be massively optimistic about the short-term economic outlook here in Europe, given that there is so much political uncertainty.
And wrapping up with the results of the survey, and Yaniv, so no impact here. Fed bearish or Fed holding is not convincing anybody of a new direction. But Yaniv, I wanted to get your thoughts on where the market is going vis-a-vis the sort of fundamentals here that we see the general, and you've mentioned it, I think 2 or 3 times now, that the demand growth, global demand growth for oil in this year is a little over 1 million. We're not seeing the kind of crazy differential between the more bearish and bullish outlooks of the year. And yet what we are seeing is that the more than likely non-OPEC plus countries will add more barrels than the demand growth, which doesn't happen very often. Where does that leave OPEC plus? I mean, coming back with more barrels in the market, or they're due to release their next policy change on April 1st. Where do you see those balances going? Will OPEC plus tolerate the non-OPEC plus swallowing all this minimal demand growth?
Well, that's the golden question right there. So, what will OPEC plus do? Yes, our non-OPEC plus growth year on year is sort of 1.4, 1.5 million barrels a day, coupled against just over 1 million barrels a day of pure demand growth. So that definitely leaves the crude market, especially in a slight surplus, without already considering what OPEC plus would do in terms of the eventual ramp up of production. So very tough spot, we would say, for OPEC plus. What they would want is to maintain backwardation at these levels. It has spiked up, has remained fairly elevated beyond the last couple of weeks, basis sanctions on Russia, vessel availability, and the medium sour or just the sour market tightening further. But then couple that with what's due to come with the tariff that were extended on Canada and Mexico, but they will come into play at the start of, or the end of this month, start of next month, which will further tighten the sour market. So what would OPEC plus do? They've got to maintain that backwardation. Firstly, they want to keep the prices supported, and they want to ensure the compliance, right? So we had Donald Trump mention to OPEC plus nations that, guys, you've got to increase your production, and they swiftly declined that notion. So we do feel they're going to stick together more cohesively as a unit. but
I mean, the
also
fact that they're so
yes.
quiet so far this year seems, I would generally regard as good news for OPEC Plus when there isn't any sort of internal quarrels, as we had a little bit of it last year when Iraq and Kazakhstan are being naughty and, you know, headlines here and there. But this year it seems to be quite quiet and quite homogeneous.
Exactly so, right? And I think there's a key element here in that the cohesiveness of the group is keeping the prices at these levels. So, you know, ensuring that safe supply, but not oversupply is what they would look at, but allowing themselves to output products into the market at the rates that products are valued at right now is probably going to be a key factor. Now, one last thing, just I know before we round up here, is looking at how Europe is definitely in a difficult position. That is from the products angle, from products market, somewhere that the Middle East could target and continue their exports into. So I think let's not be afraid or let's not be shocked should, when the decision time comes, that the OPEC Plus cartel will extend their cuts. But there is a very real possibility that production could ramp up.
Well, we'll have to leave it there. We've got Brent trading just a little bit down, so fairly negligible. It's trading 76.76, and the outlook. Just on one point, I suppose, is where OPEC goes. Is where does non-OPEC plus production go? And we've seen just in the last days, the EIA revising upwards their outlook for U.S. oil production this year, incrementally creeping up towards that big number, 14 million barrels a day. So it's certainly not going down. And will that actually surprise on the upside? That will be interesting. Thank you so much. Great to have you guys on. Neil Atkinson, Malia Bengali, and Genevieve Shah. We look forward to seeing you all in London for IE Week, when maybe somebody will find a North Star. I'm sure it's usually that consensus sort of scenario. Oh, yeah, I agree with you. You agree with me. Cheers. Let's go to the next party. All the best, guys. Take care.
Thank you. See you in London.
Thank you.